Certain assertions which are made by the management, and when these assertions are made by management, what are the steps you take actually here to ensure that these assertions, the risk of material misstatement is minimized in these assertions which are based on certain accounting estimates. See, accounting estimates are the approximation made by management to which is due to lack of precise means of measurement. Accounting estimates comprises of say provisions and the contingent liability. Now you have how does a management reduces the risk of material misstatement in case of assertions which are based on the accounting estimate is the question. First of all, SA 540, which deals with auditing accounting estimates, including fair value accounting estimates and related disclosure, the auditor shall obtain the understanding of the following in order to provide a basis for identification and assessment of risk of material misstatement for accounting estimates. So, what are the things auditor will apply? First of all, the requirement of applicable financial reporting framework which is relevant to accounting estimates and the related disclosure. So, what are the applicable financial reporting framework? Here, when I say applicable financial reporting framework, it is nothing but the AS 29. You have provisions, contingent liability and contingent assets, and a similar standard in Ind AS you have. So those standards related to that we have to consider. Then how the management identifies the transaction events condition that may give rise to the accounting estimates, how they are recognized, how they are disclosed. See, if it is a contingent liability, then you have to make a disclosure in the notes to accounts. If it is a provision, then you have to make a adjustment in the financial statement. So how it is being done? See, if it is a litigation case which is pending where you are not able to estimate what is the actual amount, the possibility of winning the case is more than 50%, then you have to make a provision. And if the possibility of losing the case is more than like say if the possibility of winning the case is more than 50%, then you have to create a contingent liability, not the provision. And if the possibility of losing the case is more than 50%, then you have to create a provision. So what is the procedure, how the management identifies the transaction events in relation to the accounting estimates? In the financial statement, in obtaining the understanding, the auditor shall make inquiries of management about the changes in circumstances that may give rise to new and revision in the accounting estimate. See, for example, say last year the company was losing the case, they made a provision. This year, because of some new facts, company may win the case. So in such case, they have to create a contingent liability. So there is a revision in the accounting estimates. You need to discuss with the lawyer, you need to discuss with the consultant, you need to talk to the management, you need to talk with those charged with governance. Further, what is the estimation making process adopted by the management? So what is the estimation making process adopted by the management? Even that also should be considered. That's the thing actually here. So now, my dear soldiers, that's the thing is that, so what is the estimated making process that you have to understand? So first of all, the method where the applicable model is used in making the accounting estimates, that is the first and the foremost thing actually. So what is the method included where the applicable model is used in making the accounting estimate? What is the method they are using? What is the relevant control? What are the relevant controls you are having actually here? And are you taking whether the management has used the expert? Say example, you're making a provision for warranty. So provision for warranty on electronic items. So there may be involved some electronic engineer to estimate what are the assumptions which is basis for creating an accounting estimates, and whether there has been any change in the prior period method, that you have to understand. What are the changes which has happened in the prior period methods for making the accounting estimates, and how the management has assessed the effect of estimation uncertainty actually. So if there is any estimation uncertainty, how they have assessed the estimation uncertainty, that you have to understand. Okay, so first of all, please understand that as a auditor of a company, you should understand that what is the basis in which they do the assessment of what is the basis actually, they have to identify and assess the risk of material misstatement for an accounting estimate. Accounting estimate, because it is based on assumption, And that assumption may not be realistic in nature. It is based on some information which is not complete. So that it may not be complete in nature, and that is why it may give rise to the risk. Okay. Sometimes you may not have a proper measuring model. So those factors aspect will come into consideration. Okay. I'll see you in the next video.